I work with most of you, but I'll introduce myself. My name is Laura Deely. I'm a senior financial consultant at Manning and Napier, and I'm joined today by two of my colleagues that I'm very lucky to work with. Our main speaker today is Veronica Van Nest. Prior to joining Manning and Napier in 2008, Veronica spent 12 years in private practice at a law firm in Buffalo and mentored under one of the most well-regarded trust and estate attorneys in the city. Currently, she's a vice president and trust officer at Exeter Trust Company. She reviews and administers trusts for clients, where Exeter is acting as either co-trustee or trustee. Veronica wears a lot of hats at our firm. She is also a senior wealth management consultant for our advisory services group. Most of you have worked with Veronica. She reviews clients' estate plans for no additional cost, by the way, and has them take suggestions to their estate planning attorneys. One thing we want to emphasize is that Veronica does not replace clients' attorneys. She's a sounding board for you to take suggestions to your own attorney. And she's a wealth of information. In addition to Veronica, we have Cody Brody joining us. Cody came to Manning and Napier at the beginning of this year. He is on the Buffalo, Western New York team with me. Prior to joining Manning, he worked at Goldman Sachs and Merrill Lynch and has 10 years of industry experience. He's a great guy, hard worker. I encourage you, if I'm not around, to contact Cody. He's fantastic. So with that, I just want to also emphasize that this is a smaller group on purpose. We want this to be interactive, so feel free to ask questions. If you're shy, you can also put them in the chat. So I will ask Cody to go over our agenda for today.
Thank you, Laura. We do have a very simple agenda today, and I will be a little bit repetitive and kind of go over some things that Laura stated, but as she mentioned, because we want this to be interactive, please, if you're comfortable, feel free to turn on your cameras if you haven't already, chat your questions in the group chat below, or simply raise your hand or jump in and interact with us. We will have allotted time at the end of this session as well for questions. If you do ask a question and it requires a little bit more of a technical response, we may put that on hold until the end of the event just to get through the materials first, but we will promise we won't forget about you. Additionally, we're happy to speak with you one-on-one after the event if you have further questions, or if you prefer not to ask your question in a group setting, which is totally fine. We also sent out an email with some documents. If you didn't receive them, don't worry, we'll be resending the materials again after this event. And with that, I'm going to kind of dive in and get started here. So to start, estate planning is a key piece of the financial planning process for everyone. Whether you just started a family and are beginning to save money, or you're retired and thinking about preserving as much as possible and passing on assets to the next generation. I like to tell people that the base purpose of estate planning is not to leave a mess for your family if something should happen to you. This theory applies to all levels of wealth. Once a decision is made to create and administer an estate plan, there are many tools and vehicles that can be deployed to help address specific goals and challenges for that strategy. So this is why we build a discussion around estate planning and personal trust services into all of our financial and wealth planning conversations. So what do we mean when we say personal trust services? The first key point is support for you and your estate team. And this includes items like collaboration with your tax, financial, and estate planning advisors, regular meetings with you and your loved ones to review your needs, and professional trust administration and distribution services. We help with planning for now and the future, which encompasses holistic, creative, and thoughtful estate planning strategy, fiduciary advice with expert knowledge of trust and estate laws, and assisting you with implementing any gifting strategies and tax-effective solutions. Management of your legacy could mean things like integration with investment services and complete alignment with your goals, offering opinions for charitable and individual gifting strategies, and analyzing and proactively adjusting for cash flows and income requirements. And finally, attention to your details would entail managing all of the reporting and record keeping, taking care of distributing trust assets to your loved ones, preparing and filing tax reforms, and responding and adapting to your family's changing needs and situation. So with that, I'll turn it over to Veronica to continue.
Sorry, I had to find my unmute button there. So, as Cody and Laura both said, we do offer these personal trust services. I am a trust officer in the trust company, where we are currently acting as a trustee or co-trustee on 100+ trusts for Manning and Napier clients. They run the gamut from very, smaller trusts for grandkids, for education, to larger trusts for spouses, to charitable trusts, also to larger employee benefit trust. So we do pretty much operate as trustee or co-trustee of the gamut of trust opportunities that you may use. And in acting as the trustee, what we can do is, individuals you name may not want the responsibility of acting as a trustee. They may not be able to take on those responsibilities. So it's important to have someone that can do that can manage the trust assets, that can make sure the tax returns are filed, that can communicate with the beneficiaries, that can evaluate distribution decisions. A beneficiary comes to the trustee and says, I want X amount for Y purchase. And the trustee has to evaluate that. And sometimes it's difficult for a family member to say no to their sibling or to their child. So we can operate and be the bad guy and say, no, the trust doesn't allow for that. That has happened. We've had to do that for clients, because especially in the co-trustee role, because the family member wants to maintain the family integrity, and they don't want the Thanksgiving table to be a war zone. So we're able to help out with that, and able to help out with all that back office, those back office things that trustees have to do. Sorry, I went too far. So as Cody said, you were emailed some documents prior to this. One was our trust checklist. So the trust checklist is a document that we created to help people get ready to think about doing their estate planning. When I was in private practice drafting documents for clients, when I received a call from a client, my discussion with them was, okay, you need to, we'll schedule a meeting. You need to come in with a list of your assets, who your beneficiaries are, who you want to be your executor and trustee, give some thought to how you want your estate distributed. And that can be a daunting task for a lot of people. One thing is you're facing your mortality. So that's hard for all of us, I think. You might have some difficult family situations that you have to work through, and that's also difficult. I often say that I'm somewhat counselor as far as attorney, because a lot of when estate planning is being done, a lot of family issues come to the fore, and parents have a frank discussion about whether their children can manage assets, whether there's any reason that they shouldn't. And you really have a lot of family discussions when you do this. So it's really important to get everything together and kind of think about what you want to do. One of the really important things is identifying your fiduciaries and your beneficiaries, but mostly the fiduciaries, because those fiduciaries are your executor and trustee. If you have minor children, it's a guardian, which that can be, a difficult decision to make. But your executors and trustees, you want those to be people that can manage the estate after you die, and they should be people that you've spoken to about that role, that they feel comfortable doing that. Because the last thing you want is somebody to be named as executor or trustee, and then they'll come and say, "No, I really don't want that role." So you want to think about that. And, it's one of the things we do emphasize with clients when we meet with them annually is, okay, these are your current fiduciaries. These are your current beneficiaries. Do we need to make any changes? So I think it's important to kind of use that checklist to think about what you might need to do before you go into an attorney's office to update any plans. I think, Laura, you were gonna.
Don't we have a poll?
Oh, I think we do. I think we do, Shreya. I think we have a poll that we were going to give here. Oh, there it is. Yep.
So as you can read, the poll is, when is the last time you looked at your estate plan? So your answers are anonymous, and we'll give you a couple of minutes to pick which is most relevant to you. So this does not surprise me. I do not have one yet. You're a perfect candidate to be on this call. It's a daunting task, as Veronica said, but it's one of the most important things you can do. So in the trust and estate world, I've learned that there are a lot of acronyms, a lot of terms that are used that can be confusing. This is a list of some of the more common trusts that we see. And Veronica, we've seen a lot of disclaimer trusts, most recently in a lot of client estate planning documents. Can you explain what a disclaimer trust is?
Yes. So traditionally, we used to see a lot of, I love you wills, which were, one spouse gives everything to the other spouse, and then to the children, there might be trust for children. Then as estate tax limits, kind of rose and people's estates rose, we saw trust for spouses. But in my experience, it's a little bit, spouses aren't too happy sometimes when there's a trust for their benefit that's created with some estate assets. They may not like the fact that they have to go and ask either, the corporate trustee, their child, whoever, if they want money from their trust. So what the disclaimer trust does is it's an optional trust. So this type of trust would be, you look at it at a moment in time. So husband and wife will have the husband pass away first. Unfortunately, that's usually how it happens. So the husband passes away, and we look at the size of the estate at the time that the husband passes away. We look at the size of the estate. We look at the estate tax laws in effect. We may look at, if we're doing planning for you, we would also kind of look at what your planning modeling looks like. And we decide at that point, and this discussion is usually had, with us as your advisor, with your accountant, with your attorney. It's a holistic discussion where we talk about, okay, does it make sense for you to disclaim, meaning say, I don't want, that's all disclaimer really means, saying, I don't want particular assets from my spouse. Instead, I want them to be held in a trust. We establish those trusts if there is the potential for estate tax being due, because these types of trusts escape estate taxation on both spouses' death, no matter how big they get. So if one spouse dies and you decide to establish a $2 million disclaimer trust, the surviving spouse does, then that when that surviving spouse dies, the trust is worth $20 million. That $20 million escapes estate taxation. There's no estate tax due at either death. So it's a very good tool, and it's especially important now because of the changing estate tax laws. And it gives us a lot of flexibility because it really allows us to determine, when we know what the estate tax laws are, does it really make sense to set up a trust or not? One important point to make on this is these decisions have to be made within 9 months of the individual's death. So it's important to keep that timeline in mind if this is something that's part of your estate plan, or that will be.
Thank you. When I worked at a bank in the trust department, I used to hear a lot of acronyms, and one of the most frequent was ILETS this and ILETS that. And it wasn't for a bit until I learned they were actually irrevocable life insurance trusts. Can you explain what they are?
Yeah, so these are, as the name says, they're irrevocable trusts. And they hold life insurance. It's the title kind of gives it away. But what's nice about these is that the life insurance that's held in the trust escapes estate taxation at your death. So individuals who might have, $1 million policies or several $1 million policies, those policies are included in your taxable estate when you die. So your estate will pay estate tax on those policies, unless they're held in an irrevocable life insurance trust. With these types of trusts, you do have to make sure that they're properly structured, that generally what happens is the individual sends a check for the premium to the trustee. The individual who creates the trust, the grantor, sends a check to the trustee to pay the life insurance premium each year. The trustee then makes that payment. Originally, when these are set up, the trust actually purchases the life insurance. If that doesn't happen, and for example, you have, you're just learning about these ILETS now, and you have some life insurance policies that you want to have set aside. If you transfer those into a life insurance trust, you do have to survive for 3 years beyond that transfer in order for them to be out of your estate. And what's a really good part of these trusts is that they're really built for liquidity. So, anybody who's ever collected life insurance on an estate, you basically produce a death certificate and you get the check. It's usually a very quick process, a couple weeks or so. So these trusts are really good for situations where there might be an estate tax liability owed, and maybe the individual who passed away, all they have are retirement accounts, or the biggest part of their estate is retirement accounts. Or you might have a business owner. Laura and I have mutual clients who they own a family business, and they're 2 siblings, and they just set up, they each set one up. One of the siblings is married. She set up a $10 million policy in an ILET, and her brother set up a $5 million policy, because they own a substantial interest in a business, and this will provide some liquidity if they need it to pay estate expenses. And again, it's very useful if you also have large IRAs, because the last thing you want to do is take money out of those IRAs to have to pay estate expenses. You want to have some liquidity there.
Right, good tips. The last one, charitable trust, I think we can infer what that is, but if you wouldn't mind going into detail.
Yeah, so charitable trust, there's several different flavors. The 2 basics are charitable remainder trust and a charitable lead trust. So a charitable remainder trust, this can be established while you're alive. Both of these trusts can be established while you're alive or at your death. The charitable remainder trust creates a stream of income for an individual for either their lifetime or for a certain amount of years. And then when that term of years expires or the individual passes away, then the whatever's left in the trust passes to the charity that you've chosen. Generally, those trusts, you're able to change the charitable beneficiaries. So if your charitable intent changes over time, you're able to have some flexibility in doing that. The charitable lead trust is just the flip of that, where the charity gets money up front and an individual or another trust will receive money on the tail end. We have a charitable lead trust, which we were acting as trustee of in a couple of years ago. The individual created the charitable lead trust with about $5 million. She was concerned about the estate tax laws and was very charitably inclined. She has a private foundation as well. The charitable lead trust paid $250,000 a year to various charities, and she had named, I think there were 5 different charities. And then once she passed away, the charitable lead trust terminated and established 2 charitable remainder trusts for the grantor, the individual who passed away, for her stepdaughter, and then another one for her bookkeeper, and for the private foundation. And then eventually everything will flow back to the private foundation. But that's a way to kind of double up on that charitable deduction. So she did get a very large charitable deduction for creating that trust. So we've seen with charitable trusts, we've seen a couple of different planning tools recently that have become very useful. One is naming the charitable trust as the beneficiary of your IRA. So if you are charitably inclined and you want to pass some money to charity, the charitable trust is a good way to go, a charitable remainder trust, because the IRA rules changed a couple of years ago. And if you leave an IRA to your child, they're going to have to take the IRA balance out within 10 years. If you instead left it to a trust for your child, and a charitable trust would give you the benefit of a deduction on any estate tax return. If you leave the IRA to a charitable trust, the individual doesn't have to take the IRA out within 10 years. The IRA would flow through to the charity, and then the trustee of that trust would pay out the distributions each year to the child, but it would be a much longer time frame generally than the 10 years. The other thing that we've seen it used for as well is for if somebody is selling a business. So there's the ability, if you are selling a business, to be able to use a charitable trust to hold part of a family business. And that charitable trust holds that family business interest. So then when the business sells, the charitable trust collects the money and doesn't pay capital gains on the portion of the business that they own. Now, this has to be done early. It can't be done, we've gotten the calls where it's, the transaction's closing in a couple of weeks, and, what can I do to save taxes? Well, you can't use it then because the IRS is really going to look at it. Instead, you have to kind of plan. So if you think, in a couple of years or in a year and a half or so, I'm selling my business, maybe it makes sense to set this up because I do want to give some assets to charity. It can be used there too.
Thank you. Does anyone have questions on any of these trusts so far? Don't be shy, or you could put the questions in the chat. Okay, I think we can move to the next slide. So back in the day, many years ago, we used to see a lot of marital and credit shelter trust use, and I would say that has diminished greatly over the last several years. Can you explain what a marital and credit shelter trust is and why they've sort of waned in popularity.
Yeah, Laura is exactly correct. Traditionally you would see these in older documents, you see these quite a bit. It has kind of lost flavor a little bit, and people have gone more to that disclaimer trust planning that I was talking about on the previous slide. But a marital and credit shelter trust planning, we call this an AB trust structure in the estate planning world. So how this works is that you are allowed to shelter a certain amount of your assets from estate tax. And that number changes every year. That's the exclusion amount that everybody hears about. This year, it's 12.92. Next year, it's going to be 13.61 million. So, and if you're in New York, it's a little less than 7 million currently. So what these trusts are designed to do is you establish one trust with the credit shelter trust is established with that exclusion amount. So for example, you have a $15 million estate. You would establish that credit shelter trust with the 12.92 million that you're allowed to shelter in 2023. And then the marital trust would be established with whatever's left, the 15 minus the 12.92, which I think is 2.08 million. So you would have two trusts. Both trusts aren't taxed when the first spouse dies. When the second spouse dies, the credit shelter trust isn't taxed at all. It's not taxed either time, regardless of what it grows to. So if it starts at 12.92, grows to 30 million, 30 million will pass to your heirs estate tax free. Whatever's in the marital trust, however, will be taxed at the surviving spouse's death. So when we're doing this planning, what we tell clients to do is to really spend down that marital trust as much as possible. Start, taking distributions from that marital trust and spend that down so that you're not touching the credit shelter trust. So that credit shelter trust can grow estate tax free for as long as it's in existence. But again, we haven't seen this as much except for the really high end estates that, the 20s, the $30 million estates that, individuals still want to do some of this planning. Sometimes you see these in second marriage situations too, because you want everything to flow through to a trust for a spouse, and then so that your children from a prior marriage may receive everything after that. And you don't really want to engage in that disclaimer trust planning if you're in a second marriage.
Thank you. So yet another acronym, SLAT, Spousal Lifetime Access Trust. The name gives a little bit of it away, but perhaps you could explain it in more detail.
Yeah, so this is a trust that for the last couple of years, it's gotten a lot of play. There's been a lot of information out there about them. We actually are currently acting as trustee, as co-trustee of one right now that was established a couple of years ago. I was just down in Alabama with clients last week, 2 doctors, and they're going to be establishing these as part of their estate plan. So this type of trust, what it allows you to do is, I've used this expression many times, Laura's heard it multiple times, have your cake and eat it too. So it's basically one spouse establishes the trust for the benefit of their spouse. So husband establishes it for the benefit of wife. Husband uses part of that exclusion amount that we talked about. So husband uses, if they want to use their full exclusion amount, they use 12.92 million, establish it for the benefit of their spouse. During that, husband establishes, so during wife's life, she has the ability to receive distributions if she needs them. Again, this is a trust that you kind of want to establish and let grow and not really take distributions from. But what's nice about this type of trust, any irrevocable trust that you establish, you really have to give up dominion and control over the assets and the management of the assets. What's nice about the SLAT is that even though the husband is giving up control of the assets, wife still has the ability to access the trust assets if she needs it. And sometimes also you'll see these trusts set up not only for the spouse, but also maybe for children. One of the drawbacks to these types of trusts is if there is a death of the spouse or a divorce, then the spouse who created the trust does lose access to the funds in there. But that's why a lot of times you'll see these established with children also as beneficiaries, because then the children can access money if mom or dad really need it, they can access money from the trust. It has, as I said, it's gotten a lot of play both in the estate planning world, but also in reality. A lot of clients are considering it because one of the biggest stumbling blocks to doing any estate tax planning is that you have to give up control, and people don't like that. So this gives them the benefit of still having access to the assets.
So Veronica, moving on to the next common type of trust, I often get questions on the difference between, here we go with another acronym, but a QPERT, Qualified Personal Residence Trust. The difference between using that kind of trust and simply putting their residence into a revocable trust. Would you be able to briefly explain that?
Yep. So a qualified personal residence trust is an irrevocable trust. So this is a trust that, similar to its name, holds a lot of these you can kind of tell by the title. Similar to its name, it holds a piece of real estate. So it can either hold your current home, your vacation home. You can have two separate ones for each of them. So what happens with the qualified personal residence trust is you transfer the real estate into the trust. They have a term of years, which is usually like 8 to 10 years. And the residence is held within that trust for that period of time. Once that period expires, the real estate is out of the individual's estate for estate tax purposes, no matter how big it's grown. So, people used to use these in Florida when we were seeing a large uptick in values of real estate. Even around here, there's been a large uptick in values of real estate in the last couple of years. So people were establishing this with their real estate, and say the real estate was worth, $500,000, but it grew to, $2 million. It doesn't matter. It's out of their estate. The one stumbling block that people may not entirely like about this is that they, once that term of years expires, the parents have to start paying rent to their kids, and that has to be market rate of rent. So, you have to talk to a realtor and say, how much would a market rate of rent be for, this 3,000 square foot house, and start paying that. It helps reduce the estate, but it may not be the most pleasant thing. In contrast, if you put real estate just into a revocable trust, it's not excluded from your estate. Excuse me. It's not excluded from your estate. It's also, you're still paying all the expenses. And we do see it used. We do see transferring property to a revocable trust used often if you have real estate in multiple states. That's important for, otherwise you would have to probate in multiple states. So you don't want to do that. And that's often a reason why we see revocable trusts used if people don't want to go through the planning of actually transferring the house to their children. And I think here, going to do another poll.
Yeah, so we're going to throw a poll up here. If everybody could take a moment and answer. So this poll is asking, what is the cost, or what is your perceived cost of establishing a trust? Your first option is $1,000 to $3,000, $4,000 to $7,000, 8,000 to 10,000, or $10,000 and up. So we'll give you a moment to answer that poll, and we'll go over the results.
Interesting. So it's all across the board. What's interesting, and the reason we kind of use this here is because it really depends on what type of trust you're establishing. So that first range, 1,000 to 3,000, that's probably a basic, a will, that might have a disclaimer trust in there, that might have some trust for kids, trust for grandkids. And, when you get to that second range, that 4,000 to 7,000, you're looking at probably throwing a life insurance trust into that, or maybe even a QPERT. When you're going to the 8,000 to 10,000 and 10,000 and above, you're really you're doing some significant estate tax planning, and you're probably throwing a slat in there. You're probably, you might have a slat and a QPERT. So, as any of you who have worked with attorneys know, and I used to do this, we charge by the hour. We charge in 6-minute increments of every time we talk to you, every time we do work for you. So it can get expensive, but if you weigh the cost as opposed to the cost in estate taxes, without doing any planning, it definitely weighs out. What you're saving in estate taxes weighs out. So I really, this is not meant to say don't do estate planning because it's too expensive. It's meant to say do estate planning because you're really not paying, as much as you would pay in estate taxes.
And just to clarify, talking to Veronica does not cost money. So don't be afraid to ask her questions and work with her.
Yes. It used to, it doesn't anymore here. So this visual is nice to kind of tell you, who's responsible for what in the estate, starting estate planning. So, your state attorney, as Laura said, I don't draft documents anymore. I used to, but, here at Manning and Napier, I don't. So you would be responsible for working with your estate attorney to establish your plan, draft the trust documents, and then you're also responsible for funding the trust. And what does that mean? That means actually titling assets in the name of the trust. And that is all too often the step that's missed once people establish trusts. And it's the most important thing of the trust process. And then your trustee is going to manage everything. They're going to distribute assets, prepare, make sure that the tax returns are filed, manage all the record keeping, make sure that they're, talking to the beneficiaries, accounting to them, telling them what distributions are being made, how the assets are invested. So there's a lot of responsibility that your trustee has. As we've said on this call already, we do manage trusts, and we're able to, besides drafting the trust documents, we are able to handle all the trustee responsibilities and work with you on funding the trust and all the back office things that need to be done to take care of that trust.
Did you mean reviewing the trust documents, not drafting?
Yes, I'm sorry. Yes, reviewing, not draft. We don't draft, sorry. Sorry.
So there are some key considerations that are timely here. One of them is the sunset of various tax provisions that may be occurring in 2025. And so, as Veronica said, the federal estate tax exclusion amount is $12,920,000. Once 2026 hits, that may be cut in half. So, when I look at the date 2025, I think it's a long time away. it'll be here before you know it. And so it's important to plan for that eventuality. Anything else to add, Veronica, maybe about New York State?
Yeah, so New York State, the exemption, when it's cut in half, is going to be probably close to New York State. So New York State is, just shy of 7 million now. I haven't heard what it's going to be for 2024 yet. It'll go up by, probably a couple 100,000 or so. It generally does that every year. But I think you have to be cognizant of not only what the federal law is, but if you're New York residents, you have to be cognizant of planning in New York. And you also, one of the glitches with New York, well, there's a couple of them, but the one is that you can't share, federally, you can share the exclusion. So if, for example, you have most of the assets are in husband's name, wife doesn't have significant assets in her name, you use the 12.92 times 2, and whatever the first spouse who dies doesn't use, the other spouse gets the rest of it. You can't do that in New York. So that's important to keep in mind. The other thing in New York is that if you're 105% of the exclusion, you reach what we call the cliff, which means that you're actually, you don't get any credit in New York for the 6.92 or 6.93 or whatever it's going to be in 2024 and beyond. So it's important to kind of make sure your assets are properly titled between spouses if you are a New York resident, and also try to avoid that cliff as much as possible.
Veronica, a question just came in. It's from a married couple who has no kids and doesn't expect to be over the exemption amount. Are trusts a necessary element for their estate plan?
It depends. Trusts, creating a irrevocable trust, probably not. But trusts come in a lot of different flavors. Do you, are there grandkids that would potentially inherit? And should they, or no, there's no kids. Okay, so no kids.
What about avoiding probate?
Yeah, I was just going there. So the issue with in New York State, when you probate a will, you have to notify the heirs that would have inherited had you not had a will. So if it's a married couple, it's your spouse. But if only one of you is left, then it becomes your sibling, your parents, your siblings. You have to kind of go in until you find an heir that's that can inherit. So avoiding probate, if you don't have kids, I have encouraged clients historically, and I would encourage having a revocable trust instead of a will. Because with a will, you have those certain notification requirements for probate. With a revocable trust, as long as your assets are in that revocable trust, you don't have those notification requirements, and you don't have to worry about the court's involvement in administering your estate.
Can you go over quickly the probate process? It's not painless.
No, generally the probate process, once you get the death certificate, you prepare a petition for probate that names the beneficiaries that are listed in the will, the fiduciaries, generally your petitioner as your executor. And as I said, you have to notify those individuals who would inherit had there not been a will, and they actually have to sign off. They have to sign what we call waivers. If they don't sign a waiver of probate, and that waiver of probate is basically them saying, yes, I agree to the will as written. I agree that I'm not a beneficiary, or if I am, I'm only receiving X. And then the will can finally be probated. it used to be rather quick. When I was in practice, I used to walk down to the courthouse and sit with one of the court attorneys and file probate. So client came in and signed documents. All the documents were signed. I took them to court. They were, received letters testamentary that day and were able to kind of go through things. So it was a couple week process. I actually was just in a meeting with an attorney in the Buffalo area who said it can now take 3 to 4 months to be able to go through the probate process in Erie County, which that's where I practice. So it can take some time. And the issue is if the spouse doesn't have access. So if all the assets were in one spouse's name, nobody can access those assets until an executor is appointed. So imagine, you need to pay bills, you need to pay income taxes, and you're waiting 4 months to get access to funds. That's not a good experience. So it does make some sense to have a revocable trust as part of everyone's estate plan.
So if this individual doesn't live in New York State, they should check with their attorney about applicable regulations.
Yep.
Correct?
Yep.
But they do have benefits. And I believe your will is a matter of public record.
Yes,
So
it is.
not that anyone on this call has any issues with family, but you get some curious types, they can pull a copy of your will and read it, and there's no privacy. So going back to the exemption amount, there's no clawback on the amounts over future exclusion. I think I kind of know what that means, but can you explain what it really means?
Yeah, so historically, we've had a lot of uncertainty. I mean, I've been practicing for 25 plus years, and I think throughout my practice, there's been some level of uncertainty as to what the estate tax law is going to do. And as estate planners, we were always concerned that if we made a substantial gift now, and the estate exemption was less later, would the government come back and say, no, you gave too much, we're going to tax that? What's interesting about this newest iteration and the sunset in 2025 is that the IRS actually came out about a year or so after the legislation was announced. They came out and they said, there's going to be no clawback. We're not going, if you make a gift of $12.92 million today, and the exemption is $6 million or $7 million in 2026, we're not going to come back and say, 12.92 minus 7 million, you have to pay tax on the 5.92 that's in excess of the exemption. So they've given some comfort to individuals who think they will be over the exemption to say, do planning now, get it out of your estate, and we're not going to come back and penalize you later. That is significant because that has never happened. They have never come out with this no clawback type advice. So it leads me to believe that there will be a sunset in 2025 because that the IRS has come out with that.
And so we can see here, estate tax over the exclusion amount, the percentage is quite high, 40% federally, and then there may be estate taxes depending on which state you live in. Here in New York, it's what, 7 to 15?
Yeah, it's like 9. Yeah, like 9 to 15. Yep.
So, obviously planning early is a good thing if you have assets that might be over the exemption amount in 2026. So talk a little bit about gifting.
Sure. So there's a lot of different ways you can gift. We've talked a lot about trusts and giving exclusion amounts to your trusts, but you can just make outright gifts. this year it's 17,000 per person, per individual. Couples can give 34,000 per person. You can give it to anybody under the sun. They have to be a living, breathing human, and that's about it. So you can give those money, you can give those assets away. You can do, if you have grandchildren or children with college costs, you can make gifts to their 529 plan. You can do what we call front loading the 529 plan, where you can do 5 years of a gift. So it would be 85,000 that one person could do to kind of front load that 529 so that the money's there. It has more time to grow. It grows out of your estate, but it also is able to grow for the child or grandchild. You do have to file a gift tax return for that, and you can't make additional annual gifts in excess of that. You can also pay directly college costs, and that doesn't count in the annual exclusion gift. You can also pay medical bills. That doesn't count either. So there's a lot of ways to really reduce your estate over time with just doing some annual gifting, even if you think, the trust and giving up large amounts of money is not what you want to do. You can do some significant gifting over time.
And you can gift highly appreciated stock to charities.
Yep.
Well, this is the time of year where clients ask us to look over the portfolio and come up with some suggestions for gifting to charities.
All right. There we go.
So we've gone through the cost of establishing a trust. I think you've gone through the differences between irrevocable and revocable. And the names are sort of explanatory in and of themselves. And I think someone asked the question about setting up a trust if their estate is below the exclusion amount. So unless I missed something, I think this page is covered.
Yeah, I think so. Oh, sorry. Not too far.
So common mishaps, creating but not funding the trust. Veronica mentioned this, and for clients that are in our family wealth management service.
Laura, I think, does Dr. Start, does he have a question?
Oh, I can't see him.
I think so. Dr. Satari, do you have a question? You have to, your mic's not on.
Being recorded because there's a lot of substance here and lot to digest. So if this is recorded, it is recorded. I would like a copy of it, definitely.
We'll get that to you.
Yep, it is being recorded.
Okay, great. Okay, now, is there any charge for the, and what is the charge for the trustee?
The charge,
Usual amount?
so you're generally to act as corporate trustee, it is generally 20 to 25 basis points above what your investment management fee is.
Okay. But for the individual trust, this is corporate, right?
Exeter Trust is the corporate trustee. Yes, we're the corporate trustee for Manning and Napier.
Okay, all right, okay, got it. Now, is there any guidelines to establish different trusts, like a trust between two separate trusts between the two spouses, and also a joint trust, things like that? What are the guidelines where you have trust for each of the spouse, and another trust is a joint trust between the two spouses? So what are the guidelines?
You mean, what are the terms? Like what does the trust say?
How do you decide which trust to do? Is that it?
Yeah, like each spouse should have their own trust, one, and after those two trusts, is there any reason for the joint trust? these are all different things which are confusing to us.
Yep. So the individual trusts make the most sense, I think, because then it's very clear as to, using your exemption that we talked about using that federal estate tax amount. So I recommend separate trust for spouses.
Okay.
And if you have wealth where you think, hey, I might be subject to estate tax at some point, you can consider some of the other vehicles. I've worked with you. I know how things are situated. So, do you consider maybe a SLAT? Do you consider that spousal lifetime access trust might make some sense? Obviously, if you have no life insurance at this point, life insurance trust is not an option. So that spousal trust might be something that we can certainly talk, after this separately. Once you have some time to digest everything, we can have another conversation.
Sure.
Okay.
We'll be happy to, we'll be glad to, yes.
Okay. Anything
Yeah.
else?
Thanks.
No, not
You're
right now.
Okay.
So, creating but not funding the trust is, unfortunately, a somewhat common event. And so when we're working with family wealth management clients, part of our job is to ask the question, have you funded these trusts? Are these assets in the trust? And kind of do that on an annual basis until it gets done, because we will irritate you with that, but it needs to be done. The other thing that I work with clients pretty consistently on, and I know Veronica, when she joins me, harps on this as well, is to keep your beneficiary designations updated. This would include your IRAs, any retirement plans, and insurance policies. People frequently forget about the bennies on their insurance policies. And so Veronica and I had a situation where we met with a client who had an IRA that was not managed by us. And we would frequently ask her, have you named your son as a beneficiary? That was the only family member she had. And she would say, yes, yes, yes. Then when she passed away, we found out that she actually had the estate as the beneficiary of the IRA. And so Veronica can go through some of the pain of having the estate as an IRA or a retirement plan beneficiary.
Yes. So when the estate is the beneficiary, the estate is an actual entity. So once an individual dies, their estate becomes the entity that, for tax purposes, that holds all the assets that the individual held while they were alive. So, for example, an individual passes away in March of 2023. Their 2023 income tax return is going to cover any income earned on their assets from January to their date of death in March. And then an income tax return will need to be prepared for their estate for as long as the estate remains open on an annual basis to cover all the income earned from their date of death, and it goes forward a year. So if they die in March, their tax return would start in April and go through till March of the next year. So if the beneficiary of an IRA is the estate will have to remain open until that IRA balance is paid out. In the case that Laura and I had, the IRA was smaller, so they kept it open for like 3 years to be able to get the IRA balance out, because the estate is paying the taxes on the IRA, the RMD coming out. So, but for large IRA, so say somebody's got a $5 million IRA, that's a significant bill to pay each year. And to keep the estate open for up to 10 years to get that IRA balance out. You do not want to have an estate as a beneficiary. You want to make sure you have people named. You want to have, if you have a trust name, that it's, the trust is clearly identifiable. You do not want to name your estate.
And not only that, the son did not get along with the attorney. So you got to factor that in. So, we have a lot of client stories, but I think sometimes people like to hear about celebrities that, don't do what they should have done with their estate planning. And, you assume they have access to the finest lawyers and accountants in the country or the world. But if they just do nothing, that can't be helped. So the one that we usually cite is Prince, who died without any estate plan. And about 45 people came out of the woodwork claiming to be beneficiaries of his estate, which was large. It was between $200 and $300 million. One of those 45 people was actually in prison. So after, several legal proceedings, the family was able to become beneficiaries, but the estate owed half of that money in estate taxes. So, failure to establish a plan is sort of a plan to fail for your family. So, we can't emphasize that enough.
Yeah. And one of the other things that isn't here that I did want to hit on, and I try to hit on this with clients, is powers of attorney are crucial. Powers of attorney, financial powers of attorney are crucial for everyone, no matter what age you are. Those documents allow individuals to make financial decisions for you if you're unable to do so for yourself. They are extremely important. I was on a call a couple days ago with the daughter of a client. The client has IRA assets with us as well as a taxable account, and he has some declining health and some dementia, and he is not able to sign anything, and they cannot access his accounts because they don't have a power of attorney in place. So the only alternative is to go to the courts and have the court actually appoint someone, and that's going to cost them. Power of attorney is, going to cost you $100 to $200, probably max, and that court proceeding is going to be probably $15,000 to $20,000 with all the attorney's fees and filing fees that have to be paid. So that's another thing that I wanted to address here is really make sure you have powers of attorney, make sure that you have named primary and successor agents so that those are effective if you need them.
So on this slide, we just have our contact information, us being myself and Laura. You will get a copy of this, so we'll be providing all this information to you. And if Veronica, if you could go to the next slide, and I'll kind of wrap things up here. So we have a deal for you today. You can continue this estate planning conversation one-on-one with Veronica at no charge. In 30 minutes, you'll have a conversation to discuss your goals, review current documents, and determine if a trust will make sense, as well as prepare you for the next steps and what you will need when you meet with your estate planning attorney. So for those of you that are tech savvy, you can use your phone to scan the QR code in the slide deck to schedule a call with us. Or if you'd like to get in touch with us via email, we've shared a schedule a call link in the chat, as well as I mentioned mine and Laura's email addresses. You'll also be receiving a follow-up with some additional resources, so please don't hesitate to reach out if you have any questions or if you'd like to set up some time to see if a trust makes sense for you. On behalf of all of us here, we thank you for attending the presentation today. We hope you found this session to be valuable as you begin to think about the type of legacy you'd like to leave, and we hope you have a wonderful rest of your day. Thank you.
Thank you.
Thank you.